Welcome, guys. In this episode, classic episode, we are doing activity 4.1 and we are also doing activity 4.2. Now, without any waste of time, I hope you were able to recap on what we did on the previous video, and you're also very fresh. You can still remember exactly what we did, because remember, I also gave you an activity on this to say go home and use Google, use the internet, use Yahoo, use all the search engine platforms to gather information on the definition that are important in terms of this learning unit. Now, without waste of any time, let's begin. Okay, first activity, remember the following definitions, concepts that I said you must learn. Yes, they are now appearing on the screen. As you can see them, they are passing one by one. Just make sure that you remember why I gave you the homework, guys. I gave you the homework. I gave you that assignment that you were supposed to submit on RC Learn, because I wanted us, when I start with the work, at least you have an idea of what is required from you. It will be very premature of us to just do the activities without first giving you guys a chance to learn on your own, to go out there and find out what all this definition that you're seeing on my screen mean. So that homework was very important, and if you were not paying attention to it, please, going forward, please pay attention to everything that we do, because next time when you write, these things are going to be there and you don't want to miss out anything. Okay, now let's go into it. I like first by looking at the requirement of what we're supposed to do. So here the requirement is as follows. You are required to complete the following statement by inserting the most appropriate insert from the list provided above in each open space. Assume all parties are registered for VAT vendor. Okay, now based on what we are given, let's start with statement number 1. We just need to put in the correct wording for it, or the correct concept. The first one says a client enters our store and purchases merchandise which she pays for in cash at the counter. Our bookkeeper must record this transaction in the book from A, or A, then there's open spaces for you. So this is a homework, guys. I am thinking that, I'm assuming that you have done it, so I'm going to give you answers to it. So number 1, a client enters our store and purchases merchandise which she pays for in cash at the counter. Our bookkeeper must record this transaction in the cash book. From A, then there's a space. So we must record this in the cash book receipts from a cash register roll or a duplicate cash invoice. Now, do you know how my answers are like that? First answer, we must record this in the cash book receipts from a cash register roll or a duplicate cash invoice. You know why? Because this client bought the items on cash. So remember, we said cash book receipt, we use it to record all the receipts that we receive in the business that has a potential to increase the bank account. So here we will record this in the cash book receipts, and the information you're going to get it from the cash register roll. Now someone might ask, what is a cash register roll? A cash register roll, simply it's a till slips that you get from tills when you purchase items. It normally comes in a roll that they put inside the cashier's counter. So that roll, it will give the client a cash receipt, but it will also keep the duplicate on that roll. So at the end of the day, we are just able to take out the roll and look at all the transactions that the cashier was doing or was processing during the business. Number 2, they said a client enters our store, purchases merchandise on account. Our bookkeeper must record this transaction in the journal from a duplicate credit invoice. So our bookkeeper must record this transaction in debtors journal from a duplicate credit invoice. Now let's go back. We have a client who enters our store. They purchase merchandise on account, meaning that they bought this merchandise on credit. So if you buy on credit, you are not buying on cash. We are actually increasing your debtors account. So that's why we record this on debtors journal. Now we issue out a duplicate credit invoice. In fact, when we issue a credit invoice, the customer will take the original credit invoice and the business will remain with the duplicate credit invoice. So we will use the duplicate credit invoice to record on the journals. Now, number 3, a tenant pays his rent in cash. The tenant is a registered VAT vendor and uses our building for business purposes. Our business needs to issue and record the transaction in the from the duplicate. So number 3, a tenant pays his rent in cash. The tenant is a registered VAT vendor and uses our building for business purposes. Our business needs to issue a cash invoice and record the transaction in the cash book receipts. Now let's look at this again. This one is a tenant who is renting a building from us. He comes and pay that rent in cash. We give him a cash invoice and we also record that in the cash book receipts. Number 4, our business buys goods and services on credit from a supplier. Now listen, this is very simple. We are buying on credit from the supplier. I think you know the answer already. If you buy on credit, we know a few things are involved. This time, it's not someone buying from us, it's us buying from them, meaning that we are creditors to the people. So one thing that you're going to use, it's creditors journal. And one thing that you're going to use, it's, remember now, you're not the business to this person, you are a client. It's like you are a customer. So they're going to give us a duplicate credit invoice. Let's check the answers. Our business buys goods and services on credit from a supplier. We will receive original tax invoice. Like I was saying, we receive the original tax invoice because we are now the customer. So you receive the original one. Then our bookkeeper must record this in the creditors journal. Number 5, we are unhappy with goods purchased from the supplier in number 4 and return the goods together with a compliant, which is your goods returned note. The supplier agrees to credit our account and issue what we call a credit note. Every time if a supplier is happy that you are returning the goods, they will issue a credit note. If a customer returns goods to the business, we will also issue a credit note. And where are we going to record the credit note? If it's us returning the goods to the supplier, we will record that on the creditors allowance journal. But if it's customers returning goods that they are not happy with, we will record that on the debtors allowance journal. So for this, we record on the creditors allowance journal. Number 6, a debtor in number 2 is unhappy with the price charged on the transaction and requests a discount or a rebate of 50%. We grant this discount and issue a credit note to the customer. Our bookkeeper records this entry in the debtors allowance journal. Later that day, the client circles the rest of the amount due in cash and we issue what we call a receipt to confirm that the money has been received. Straightforward. Number 7, any purchase made from money in the petty cash box will be recorded in what? Obvious. Money Any purchase, any transaction that we make from the petty cash box, will record the transactions under a petty cash journal. Then the source document for that will be a petty cash voucher. So we will record that in the petty cash journal after completing a petty cash voucher. The last one, any transaction that cannot be entered into of the conventional journals must be recorded in. Remember, this is the one that I said you cannot classify, you cannot allocate them in all the journals that we had. So it's a transaction that cannot be allocated. We're going to record it under general journal, and this we classify it as a sundry transaction. So we are done with activity 4.1. I hope you learned something from this. Now we are going to activity 4.2. Without waste of time, let's go to it. In this activity, it's a very short one. That's why I decided to just join them together. I'm going to do activity 4.3 aside because there's a lot of calculations, there's a lot of terminologies, there's a lot of methods, there's a lot of things I need to explain for that. So I'm going to do 4.1 and 4.2 combined, and I'm going to do 4.3 separate. I hope we are clear on that one. Okay, activity 4.3. Activity 4.2, sorry about that. Activity 4.2, let's read what they say. They say John Porter started her retail business in 2016. Sorry about that. In 2006 with 1 million in cash, which she inherited from a deceased uncle's estate. The total operating income of the business exceeds the total operating expense by 500,000 in the first year. Against all expectations, Joanne found herself with a major cash flow dilemma at the start of the second financial year. Her bank account was in overdraft. Within 6 months, she was out of business. Now, the real question here is that how is it possible that Joanne's business could be bankrupt? I mean, like, this is a business that was doing well just last year. Their income was exceeding the expenses by 500,000. So we want to know if their operating income was 500,000, and just within 6 months of the second financial year, she's out of a business. What happened? Ask yourself, what do you think happened? What do you think happened? Okay, cool. So the question is, how is it possible that Joanne's business could be bankrupt? Given the large profit she made in the first year, provide 4 possible causes for her dilemma, and what should the business learn from this? Now I'm going to just discuss this, guys. Remember what I was discussing in the first video. Very simple. We are making money, and this is what we call operating income. But remember the concept that I taught you. Accounting profit, it's not really cash. It's not really money in the bank. This could be money that is still being held by customers who must still pay. So as a business, we're already recording this as a profit for us. But when you look at what is happening, I was giving you an example. You just imagine everyone who bought things on credit or who took loans from banks. Now we are having a pandemic in the world. People are going to be bankrupt, people are going to be unemployed, people are going to lose their jobs. All these bad things are going to happen. Some of them won't be able to pay what is due. Now, those businesses are going to lose that money. There's nothing that they can do. They're going to have to write off that money that they were expecting as a profit because people are not able to pay. The danger of giving too much credit. So here what I think happened is that they had too much money that they expected, but it was not yet in the bank account. The difference between financial accounting and management accounting, very important. Again, they did not have what we call a better cash management system. Better cash management system means that you don't have a lot of money waiting and sitting in the bank, but again, you don't have less money in the bank account. You have balanced amount of money in your bank account. Why? balanced or sufficient or adequate. You don't have to have too much money. If you have too much money, you are losing, in terms of management accounting, we are saying that you are losing the opportunity for you to take that money and invest, because it's just sitting in a bank account. Chances are it's only gaining about 5% interest per annum, which is nothing. But if you can take that money that is just sitting in the bank and invest and expand, you are able to generate or maximize wealth for the users or wealth for the owners of the business. Secondly, in this case, she did not have enough money in the bank. Point number one, she had a low operating capital in the bank that she was keeping. She was supposed to keep sufficient money in the bank in cases where people are not able to pay for any other reasons. She's able to cover all her expenses, so she didn't do that. The third one that we can also have in this case, we also say that you must be able to manage your debtors book and have a strict credit policy. I mean, like, if you're going to give credit to people, you might as well as have a credit policy that is very rigid and very strict and strong to ensure that people pay within the amount of time that they need to pay. You know, if someone takes a credit today, they must be able to pay you within 30 days or 60 days, not more than that. Anything above that, you need to ensure that you also have measures to say, how do you then force people to pay, or how do you then go extra mile to collect what is due to the business. And the last one that we have for all the managers, for all the students, this is for everyone. Accounting profit is not really cash. This can be a mix of cash sales, a mix of credit sales. So it's not really cash, it's a combination of the two. So you must make sure that you manage it very well so that you limit the risk of you losing money as a business. So the other one that I need to tell you about is that you must not sell too many items on credit. Don't sell too many items on credit. Limit, manage it, make sure that you are not overselling things on credit, because you will put business in a very uncomfortable situation should things not go your way. So from myself, 4.1 and 4.2, that was it. And on this note, again, we out. I finished question 1, I finished question 2. So we are going to question 4.3. So 4.3, I'm going to do it on the next video. Hope you guys keep safe, keep well, and like I said, please subscribe to this channel. This channel is for you, not for me, not for anyone. It's for you. All people who want to learn accounting, this is your channel, especially my students. So see you on the next video, guys. Bye.